Hello everyone, welcome to the 66th episode of me learning how to trade in Forex. So in the last episode we went through, where are we? We went through the average directional index. Average directional index does not measure the, determine whether the trend is bullish or bearish, it only measures the strength of the current trend. So we've got the ADX value rising, falling below 20, between 20 and 40 and above 40, and their indications. We've got some examples here, how to trade using ADX, so knowing when to start trading, like using what ADX value and that sort of thing. Yeah, and now we're on Ichimoku, Kinko, Hayo, is that how you pronounce it? So yeah, let's get started. Below, how do you say it? Ichimoku, Kinko, Hayo. Date is the 6th. So, Ichimoku, Kinko, Hayo. Yes, you're still in the right place. You're still in the school of Pipsology and not in some Japanese pop or anime site. No, Ichimoku, Kinko, Hayo isn't Japanese for made the pips be with you, but it can help you grab those pips nonetheless. Ichimoku, Kinko, Hayo, or IKH, is an indicator that gauges future price momentum and determines future areas of support and resistance. Right, okay, so Ichimoku, Kinko, Hayo is an indicator which gauges future price momentum and determines future areas of support and resistance. Now that's 3 and 1 for Yao. Also, know that this indicator is mainly used on JPY pairs. Right, okay, so Ichimoku, Kinko, Hayo is mostly used on Japanese pairs. To add to your Japanese vocab, the word Ichimoku translates to a glance. Kinko means equilibrium, while Hayo is Japanese for charts. Putting that all together, the phrase Ichimoku, Kinko, Hayo stands for a glance at a chart in equilibrium. What does that all mean? A chart might make things easier to explain. So we've got the chart here. There's lots of stuff going on. We got some red areas, red slashed areas, some orange slashed areas, the green line, the blue line, and the red line here. Yeah. Whoops, that didn't help. A few more lines and this would resemble a seismograph. Before you go off and call this gibberish, let's break down the components of Ichimoku, Kinko, Hayo so it's easy to understand. But before we do that, there are a couple of things about this indicator you should know about first. Ichimoku can be used in all time frames for any tradable asset. It was originally used to trade rice. Ichimoku can be used in both rising and falling markets. So Ichimoku, Kinko, Hayo can be used in all time frames for any tradable asset. So I'm assuming that includes like currencies, commodities, that sort of thing. Ichimoku, Kinko, Hayo can be used in both rising and falling markets. So when can't you use Ichimoku? When no clear trend exists, so basically arranging like a market. ichimoku, kinko, hyo can't be used when no clear trend exists. Basically, when the market is trading sideways, choppy, aka trendless. Yep, you will know it's trendless when the price is oscillating on either side of the cloud. The cloud. What is a cloud? Got it, excellent. Now let's try to find out which of the lines for. Kijun Sen, blue line. So this one here. Also called the standard line or baseline. Kijun Sen, or the blue line. Also called the standard line or baseline. The standard line or the baseline. This is calculated by averaging the highest high and the lowest low for the past 26 periods. This is calculated by averaging the highest high and the lowest low for the past 26 periods. Tenkan Sen, the red line. This is also known as the turning line, also called the turning line. Derived by averaging the highest high and the lowest low for the past 9 periods. Right, okay. This is calculated by averaging the highest high and the lowest low for the past 9 periods. Chiku Sen, Chiku Span. Chiku Span, the green line. This is called the lagging line, also called the lagging line. It is today's closing price plotted 26 periods behind. It's today's closing price plotted 26 periods behind. So you're plotting it 26 periods later? Senku, Senko, span, orange line. The first Senku line is calculated by averaging the Tenkan line and the Kijun line and plotted 26 periods ahead. The first Senku line is calculated by averaging the Tenkan Sen and Kijun Sen and plotted 26 periods. There's lots of 26 being used. I wonder if that's like a special number or anything. The second Senku line is determined by averaging the highest high and the lowest low for the past 52 periods and plotted 26 periods ahead. Okay, so there's 2 Senku lines. Senko line is calculated by averaging the highest high and the lowest low for the past 52, so double of 26, and plotted 26 periods ahead. Okay, so in this chart, 10 can line is the red line, so it's this one here. Chiku span, that's a green line. Senku, that's the oranges, these two here, and Kijun Sen, that's the blue one, so here. Got it? Well, it's not really necessary for you to memorize how each of the lines is computed. What's more important for you is to know how to interpret these fancy lines. How to trade using Ichimoku, Kinko, Hyo. Senko. Let's take a look at the Senko span first. So that's the orange ones. If the price is above the Senko span, the top line serves as the first support level, so this line here, while the bottom line serves as the second support level. If the price is above the Senko span, which it is not, oh no, but how come there's like a shaded area up here? Why is this red and why is this orange? What's the difference there? If the price is above the Senko span, so if the price is above here, the top line serves the first support level while the bottom line serves the second support level. If the price is below the Senko span, the bottom line forms the first resistance level, and while the top line is the second resistance level. But why are there two resistance levels though? If the price is above the Senko span, the top line serves as the first support level, and the bottom line serves as the second support level. If the price is below the Senko span, the bottom line forms the first resistance level and the top line forms the second resistance level. Right, Kijun Sen, so that's the blue line. Meanwhile, the Kijun Sen acts as an indicator of future price movement. Acts as an indicator of future price movement. If the price is higher than the blue line, it could continue to climb higher. If the price is lower than the blue line, it could continue to drop lower. Tenkan Sen, that's the red line. The Tenkan Sen is an indicator of the market trend. An indicator of the market trend. If the red line is moving up or down, it indicates that the market is trending. It's moving up or down, it indicates the market is trending. If the red line moves horizontally, it indicates the market is ranging. Right. The Chiku span, so the orange lines. Oh no, the green line. Lastly, if the Chiku span of the green line crosses the price in the bottom up direction, so going like that, that's the buy signal. So what does it mean? If the green line crosses the price in the bottom up direction, that's a buy signal. If the green line crosses the price in the top down direction, that's a sell signal. Here's that line fill chart once more, this time with the trade signals. Chiku span, downward crossover, sell, downward crossover. Oh, here's a bigger photo, right. So, the green line, if the green line crosses the price in the bottom down direction, I guess it kind of did. Oh wait, price is here. Oh right. So I'm assuming it continued like that, but the thing went like that. So top down. So top down, that's a sell signal. So sell here. Tenkan Sen moving downwards. Right, okay, so that's the green line. Or the red line, also called a turning line. If the red line is moving up or down, it indicates that trend, that the market's trending if it moves up and down. If it moves up or down, it indicates it's trending. So red line's here. So if it moves up or down, so that bit here is going down, so the market is going downwards. Market downtrend, right. Senku span. If the price is above the Senku span, which it is not, the bottom line forms the first resistance and the top line forms the second resistance. So first, second resistance. I don't know why you would need two resistances though. Kijun Sen, the blue line. If the price is higher than the blue line, it can continue low higher. So the price higher than the blue line, not really. If the price is lower than blue line, it can continue to drop lower. Yeah, it is. So it keeps dropping low. If the red line moves up or down, it indicates something is trending. So that goes up, and it goes down, goes downwards. Right, okay. It sure looks complicated at first, but this baby's got support, resistance levels, crossovers, oscillators, and trend indicators all in one go. Amazing, right? As a trend following indicator, Ichimoku can be used in any market, any time frame. Regardless of the market, Ichimoku emphasizes to trade in direction of the trend and not against the trend. Ichimoku, kinko, hayo emphasizes to trade in the direction of the trend and not against the trend. By following trends, Ichimoku can help you to avoid entering the wrong side of where the market. Entering the wrong side of where the market. Okay, that makes no sense. Okie dokie, we've already covered a small gazboard of indicators. Let's see how we can put all of what you just learnt together. There's still so much going on in this graph though. Because which one are you actually meant to like focus on, I guess? So you got like what? 1, 2, 3, 4. You got 4, 2, 3, 4. Yeah, you got 4 different type of lines to look at. But which, like, do you focus on the green line where it's just tells you like where the buy or sell signals? But then there's also other ones where like support, resistance, and then you get, what is it, like you get the blue line, so continues to drop lower and like what? Yeah, that's a lot of stuff going on in that one. Okay, moving on to the next one. Trading with multiple chart indicators. Trading with multiple chart indicators. Now that you know how some of the most common chart indicators work, you're ready to get down and dirty with some examples. Better yet, let's combine some of these indicators and see how their trade signals can pan out. In a perfect world, we could just take one of these indicators and trade strictly by what that indicator told us. The problem is that we don't live in a perfect world, and each one of these indicators has imperfections. That is why many traders combine different indicators together so that they can screen each other. So they can like compare against each other and see if they match up or not. They might have 3 different indicators and they won't trade unless all 3 indicators give them the same signal. Fair enough. Bollinger Bands plus Stochastic. In this first example, we've got the Bollinger Bands and the Stochastic on EURUSD's 4-hour chart. Since the market seems to be ranging or moving sideways, we'd better watch out for the Bollinger Bounce. So we've got here, Bollinger Bounce is when it always tries to stay in the middle of the thing. So bounce against the sides. Check out these sell signals from the Bollinger Bands and the Stochastic. EURUSD climbed until the top of the bands, so here, which usually acts as a resistance level. At the same time, the Stochastic reached the overbought area. Oh, here, suggesting that price could drop soon. And what happened next? EURUSD fell by around 300 pips, and you would have made a hefty profit if you took that short trade. Later on, the price made contact with the bottom of the band, so here, which usually serves as a support level. This means that the pair could bounce up from there, and with the Stochastics in the oversold area, it means we should go long. If you took that trade, you would have gotten around 400 pips. Not bad. So these are like the combos to use. Bollinger Bands plus Stochastic. RSI plus relative strength index plus moving average convergence divergence. So relative strength index plus moving average convergence divergence. Here's another example with our relative strength index and the moving average convergence divergence this time. So we've got this. This is the same chart, no? Yes, the same chart. No, it's not. It's not the same chart. When the RSI reached the overbought area, so here, and gave a sell signal, the MACD soon followed with a downward crossover, which is also a sell signal. And as you can see, the price did move downhill from here. Hooray for multiple indicators. Later on, the RSI dipped the oversold region and gave a buy signal. A few hours after, the MACD made an upward crossover, which is also a buy signal. So upward crossover here. From there, the price made a steady climb. More pips for us, yippee. Yep. You've probably noticed in this example that the relative strength index gives signals ahead of the MACD. Yes it does. Yeah. Because of the various properties and magic formulas for the technical indicators, some really do give early signals while others are a bit delayed. Relative strength index gives earlier signals than the moving average convergence divergence. You'll learn more about this in the 6th grade. As you continue your journey as a trader, you'll discover which indicators work best for you. We can tell you that we like using MACD, the stochastic, and RSI, but you might have a different preference. Every trader out there has tried to find the magic combination of indicators that will give them the right signals all the time, but the truth is that there's no such thing. We urge you to study each indicator on its own until you know the tendencies of how it behaves relative to price movements, and then come up with your own combination that you understand and that fits your trading style. So, study each indicator on its own until you know the tendencies of how it behaves relative to price movement, then come up with your own combination which you understand and fits your trading style. Later on we'll show you an example of how a system that combines different indicators to give you an idea of how they can complement each other. Okay, cool, very good. Next one. What is the best technical indicator in Forex? What is the best technical indicator in Forex? Now on to the good stuff. Just how profitable is each technical indicator on its own? After all, Forex traders don't include these technical indicators just to make their charts look nicer. Traders are in the business of making money. If these indicators generate signals that don't translate into profitable bottom line over time, then they're simply not the way to go for your needs. In order to give y'all a comparison of the effectiveness of each technical indicator, we've decided to backtest each of the indicators on their own for the past 5 years. backtesting involves retroactively testing the parameters of the indicators against historical price action. Right, okay, so back testing involves retroactively testing the parameters of the indicators against historical price action. Testing the parameters against historical price action. So using past prices to test the technical indicators. You'll learn more about this in your future studies. For now, just take a look at the parameters we used for our backtest. So we've got different indicators on the left: Bollinger Bands, MACD, Parabolic SAR, Stochastic, Relative Strength Index, and Ichimoku Kinko Hyo. Parameters 32.2, 12.26.9, 0.2, 0.02, 0.022. So these are the I guess the periods. So you know, for the Ichimoku Hyo, which we just covered, 9 periods. For the red line, green line is 26 periods, and then 25 periods, so that's 52, sorry, and then 1, 26. I don't really know where that 1 comes from, to be honest. Yeah, I don't really know where this 1 comes from. And then you got the rules: cover and go long when the daily closing price crosses below the lower bands. Cover and go short when the daily closing price crosses above the upper bands. For the MACD, cover and go long when MACD 1 fast crosses above the MACD 2, the slow periods. Cover and go short when MACD 1 crosses below the MACD 2. For the parabolic SAR, cover and go long. What does cover and does that? I know what go long is, but what does a cover mean? When the daily closing price crosses above the parabolic SAR. Cover and go short when the daily closing price crosses below the SAR. Cover and go long when the stochastic percentage crosses above 20. Cover and go short when the stochastic percentage crosses below the 80. Cover and go long when the RSI crosses above the 30. Cover and go short when the relative strength index crosses below 70. Cover and go long when the conversion line crosses above the baseline. Cover and go short when the conversion line crosses below the baseline. Wait, what's the conversion line? They haven't mentioned a conversion line. So baseline is the blue line. What's the conversion line? Red line is the turning line. Green line is the lagging line. Orange line, I'm guessing that would be the conversion line. Wait, is it? When it crosses above the baseline. The baseline is the standard line for future price movements. If the price is higher than the blue line, it could continue to climb higher. Right, okay. Using these parameters, we tested each of the technical indicators on its own on the daily time frame of Euro USD over the past 5 years. We tested each of the technical on its own on a daily time frame. Cover and go short when the conversion line crosses below the baseline. Is there a graph later on for this? Yeah, I still don't really understand how the Ichimoku Kinko Hyo really works, to be honest. But anyways, Using these parameters over Yep daily on its own for the past 5 years, we're trading one lot, that's 100,000 units at a time with no setup stop losses or take profit points. With no set stop losses, so no stop losses or take profit levels, points, so just go ham basically. We simply cover and switch positions once a new signal appears. Cover and switch so if it's a buy signal, you keep buying until it becomes a sell signal. In that time, you sell. Right, okay, so there's no that, I don't know, say if it's a buy signal, you have a stop profit or take profit, then you stop at that. But no, you keep going until it turns into a loss, and then you would have to sell it then. I think that's what it means. This means if we initially had a long position when the indicator told us to sell, we would cover and establish a new short position. Yeah, so switch over as soon as there's a new indicator, as soon as a new position, a new signal appears. Also, we were assuming we were well capitalized as suggested in our leverage lesson and started with a hypothetical balance of $100,000. Aside from the actual profit and loss of each strategy, we included total pips gained, lost, and the maximum drawdown and the max drawdown. What's a drawdown? Again, let us just remind you that we do not suggest trading Forex without any stop losses. This is just for illustrative purposes only. Moving on, here are the results of our back test. Do not suggest trading Forex without stop losses. Okay, so let's strategy. Buy and hold. So you just buy it and then you just hold it until the end of, was it 5 years? You do one big trade, so you buy at the beginning, profit loss in pips, you lost minus 3,000, profit loss in percentage minus 3.442%, max drawdown 25.44. Bollinger Bands, 20 trades were done, minus 19,000 in pips, minus 19% profit loss, 37.99 max drawdown. The moving average, convergence, divergence, number of trades 110, profit loss in pips. So okay, so this one made a profit actually, nearly 4,000, 3.94%. Okay, very nice. 27.55. Parabolic SAR, 128 trades, negative minus 9,746, minus 9.75%, 21.96. Stochastic, 74 trades done, minus 20.716. Oh no, 20,716, minus 20%, 20.72%, 30.64 max drawdown. Relative strength index, 8 trades were made, minus 18,716, minus 18.72%, 34.57 max drawdown. Ichimoku, kinko, Ohio, 53 trades were made, 30,341 profit in pips. That's not bad at all. 30.34% in profit wise and 19.51 maximum drawdown. So summarizing this, Parabolic SAR has done the most number of trades. Who's made the most profit? Well, the Ichimoku's made the most profits. Who's made the most loss? Stochastic and pretty much kind of, actually no, just Stochastic made the most loss. Max drawdown, Bollinger Band's got the max drawdown. So I guess, well, MACD's made profit as well, so that's decent. So out of all of the trades, when they're done like by themselves, only the Ichimoku, kinko, Ohio and the MACDs made profits. Everyone else just lost. The data show that over the past 5 years, the indicator that performed the best on its own was the Ichimoku Kinko high indicator. Yep, it generated a total profit of $30,341, or 30.35% over 5 years. Oh, or 30.35% over 5 years. That gives us an average of just over 6% per year. Surprisingly, the rest of the technical indicators were a lot less profitable, with the stochastic indicator showing a return of negative 20.72%. Yep. Furthermore, all of the indicators led to a substantial drawdowns between 20 to 30%. However, this does not mean that the Ichimoku Kinko high indicator is the best, or that technical indicators as a whole are useless. Rather, this just goes to show that they aren't that useful on their own. True. Think of all those martial arts movies you watched growing up. Aside from The Rock and The People's Elbow, no one relied on just one move to beat all the bad guys. The Rock used a combination of moves to get the job done. Forex trading is similar. It's an art, and as traders we need to learn how to use and combine the tools at hand in order to come up with a system that works for us. This brings us to our next lesson, putting all these indicators together. Oh, this is a really nice lesson actually. Back testing, or they called it, that's going to be really useful actually, because then it allows you to test. So say if you want to do like a you come up with a strategy that fits your trading style and you want to test it, then back test that strategy and see how profitable it is, using the, I guess, last 5 years data or something, and yeah, see how good it is, and just keep testing until you find a combo of indicators that make a nice profit, or at least not make any losses, and you still are really comfortable with using it. So yeah, it's lots of experimental stuff to do there with back testing. So yeah, I am going to leave this episode here. Thank you guys for watching. In the next video we're gonna just summarize popular chart indicators, basically the few chart indicators that we've learned over the last few videos. So yeah, so I'll see you then. Peace.